It is CNBC TV18's 25th birthday, and we can't celebrate it with one person who has been a well-wisher all through these 25 years, and perhaps one of our first guests, Mr. KV Kamath, right now chairman of NaBFID, chairman of Jio Financial as well, and one of CNBC TV18's earliest well-wishers. Mr. Kamath, thank you very much for joining us. I don't know if you remember, but you were the first guest whom I interviewed as the first entrant in CNBC TV18.
I can only say time flies, all good wishes, and I'm sure the next 25 is going to come at rapid speed with even more excitement, and I'm sure NBC TV18 will continue to deliver great news, great value to all of us.
Thank you, sir. I hope you remember how we started off. You remember that slightly marshy place near Doordarshan and Worli.
Yes.
And you have even legged it over there because at that time we didn't have an OB van.
Yes.
We didn't have a satellite broadcast van.
I remember that, yes.
It's a long way since then. Now we are even able to remotely record interviews. Well, let me come to the Indian economy itself. We are talking about 1999 really, and now 2023. Our first shows were at that time. Where do you see this kind of clip that the economy has seen? The last number was 7.6. I mean, it was an amazing number. Does it look like we are now into a higher paradigm, or was that a one-off?
Actually, I was always expecting to be around 7.5%. So it was honestly no surprise. Because that was our potential, and I'm happy that the potential was realized. And it has not happened by accident. There has been, I would say, a momentum that was building up and leading to this growth. The momentum is on several pillars. The momentum, of course, is there is a demand drive in the economy that's happening. Demand happens only when there's money in the people's hand, and there is aspiration. And you also need the people who meet that demand to have the capacity to meet that demand and to invest. And of course, for them to borrow if necessary. I think all these have fallen in place. And if you look at from the time of COVID, take a very quick snapshot. Twin balance sheets were cleaned up. So there was money in the hands of manufacturing companies, the bankers. Then clearly there has been growth in incomes of people. And aspirations were always there. So it is the right time that this happened. And I would think that this is just the start of momentum, because you will now see the digital economy, the digital super cycle, as I used to call it some time back, start to kick in and overlay. It will be an overlay on that 7.5%. So let's see.
Okay.
Good news.
Well, I'm glad you touched on that, because I wanted to ask you, the recent Reserve Bank rules putting more risk weights on unsecured loans. Do you think that that might slow down, maybe correctly, but will it slow down lending? Because there was a fear in the Reserve Bank that some of the digital loans at least are being given perhaps without enough data.
I think we need to understand what is the impact of lending. If lending is a merry-go-round and it is basically washing the debt that was there, I don't think it is good news. And the pace at which things were growing, as a banker, I would think, was giving a signal that maybe there's some need for caution. Then came the second issue, where we found that there probably were multiple loans that a borrower was taking. And thirdly, a point that he's probably approaching other people for even more loans. It doesn't stop there. And to top it, the fact that look at the NIM margins, NIMs that some of the NBFCs were having. At those NIMs, you need to have a bit of caution. So to me, there were cautionary signs, and Reserve Bank has done well in tightening the requirements.
Now, you have forbidden me from asking about Jio Financial. I take your point that you are chairman and you're not CEO, and I should direct the questions to the CEO. But for the fintech sector as a whole, do you think this comes as a nasty jar?
No, it's not a nasty jar. It's a wake-up call. Okay. Because if you are doing certain things which clearly are not good systemically and for yourself, then the regulator clearly has to give a shout out to you, and that's what has happened. To me, it's a wake-up call.
Okay. How do you see the pace of economic growth. We did 7.6%, yes, but now there will be a couple of things. First of all, you will have consumption. As it is in that 7.6, consumption was not a very big piece. The bigger piece was really investment, and more of that coming from the government. But consumption could get a bit of a weight, a low down because of the higher risk weights. And plus you have, global interest rates also, which will start hurting global growth. So do you think we should be prepared for at least a year of more mellow growth?
Let me address the Indian situation, then global situation we can, because the global situation has been troubling for 3 years, so we have not really been impacted by that. The Indian situation, the first point is that the incremental lending that could have happened with lower risk weights, to me, was actually of no consequence, because it was not adding to growth. It was only recycling. That's my assessment. Somebody has to bear it out. But if the regulator has acted, and I would fully support the moves taken, then it is not adding to growth. So that's point number one. Point number two, in terms of components of growth, infrastructure, yes, and the government probably in our country for certain areas, government is the best party to invest. And now if the government can invest without drawdown from the budget,
yes,
what better situation can, you cannot be in a better situation. So, for example, if NHAI is putting out roads, and now they have what I call a perpetual financing engine to the InvIT structure. They have roads, they get matured, they are seasoned, their cash flow is good, you create an InvIT, and you invest in the next road. So that's the sort of growth that you would want in almost every area of business that is there. Then in manufacturing, there has been this point that investment is not happening, the private sector really investing. I think private sector invests very opportunistically. So if your capacity utilization is at 75% or 80%, and your implementation or lead time these days is 12 months, maximum 18 months, why would you invest in advance? And again, if one looks at and see, you have internal accruals to fund. So you don't see it reflected in bank borrowings, going for investment. I think we are in a good place. So investment is happening as appropriate, and probably more investment than we know probably is happening in the green area. Not only manufacturing companies turning green, but setting capacity for green. So there is, I think, investment happening in all the right areas. A large part of it is happening through their own books, as it were. And the rest of it will be from Indian system. The Indian system, the challenge is going to be finding longer term money.
Yes.
But it's a far change from, say, 25 years back. There was no long term money. Now you have pension money out there, you have insurance money out there, and there are other type of long term instruments and long term savers coming out there, and long term instruments coming out there. So to me, there's a virtuous cycle getting built there. We can finance these things. And to the extent necessary, if you want ultra long maturities, 20, 25, 30 years, I think companies are resorting to global borrowings. And those maturities are available out there.
Yes.
So I think it's going to be a nice hybrid model, domestic and global. Your second point on the global situation, I think we went through the COVID situation without managing our economy well and not getting any hit from the impact of things at the margin, things in the environment. The same thing happened with the situation in Europe. So I would now think that fear is a bit remote from my mind.
My fear was more that we are still running at a 5.9% fiscal deficit and states 3%. So almost a 9% fiscal deficit, which has to come down next year. And as you say, a large part of the infrastructure is being funded by the budget. The budget, there was a quantum leap in the kind of capex it did. If the fiscal deficit is brought down, won't that be a slowing down?
Yeah. My view is that what was being spent through the budget will increasingly be spent through the ability of these institutions which are doing these investments to generate on their own, in either by divestment of capital and reinvesting that, and running the thing on a fee basis. The whole thing runs on a fee basis, which then services the debt. And or private sector coming into other areas where the risk is more manageable.
Your word on the financial sector itself, what role actually do you see for fintechs?
Yeah, fintechs, I think, have changed the face of the BFSI sector. And the BFSI sector should acknowledge that to start with. And A, to acknowledge that, and B, carefully look at what is possible to do and implement that. So, for example, fintech can probably today set up a completely new app in 6 weeks. I think large banks need to question themselves as to how long will I take to do what they are doing. Is it going to be 1.5 years against 6 weeks that this kid is talking about? And then I think you'll have to recalibrate and reset your minds, because otherwise this free ride is not going to be there every day. The user
The
of
protective moat of the regulator will not last.
someday the regulator is going to run out of patience as far as the larger institutions are concerned. It's not going to happen overnight, but I think the opportunity is there, ready, and for these companies, BFSI companies, to change and reset themselves. I'm sure they'll take it.
Thank you very much. So that's a great optimistic note to end this conversation and to start 2024, that we are on the verge of at least 9% GDP growth, if not 10. Thank you very much for joining us on this very special day.
All good wishes on as you enter, finish this quarter century and move ahead.
CNBC-TV18, embarking on a quarter century of excellence.